Fed have made a massive policy error. That's according to my guest on GoldCore TV this week, John Mauldin of Mauldin Economics. But does this mean that we could see even higher inflation and the devastating impact that that could have? Watch this episode of GoldCore TV to find out. And keep watching till the end, where John reveals his real reason for holding gold in his portfolio and the only 4 equities that he owns personally. And remember, if you want to see more interviews with industry experts and thought leaders in financial markets, subscribe to GoldCore TV and hit the notification bell now. And if you want to learn how to buy, sell, and store physical gold and silver, log on to goldcore.com, your precious metals experts. John Mauldin, welcome to GoldCore TV.
Dave, it's good to be here. Let's have some fun today.
Now, I just want to quote from a piece that you wrote back in September, October, in one of your newsletters. And it says, I quote here, "In this world of negative and zero interest rates, tight credit spreads, high stock valuations, and huge amounts of global debt, even a moderate 3 to 4% inflation trend could have catastrophic long-term effects." We're at 6+% on inflation in the US. National debt has just gone through $29 trillion. We've just come off the highs in the stock market, but they're still up there. And the Fed's only now starting to signal a change in their stance to a more hawkish one. Are we in serious trouble?
I'm trying to think of a quote of a friend of mine. Something about along the lines of this: the danger is serious but not devastating. In the sense that we're going to live through this. We lived through the 70s. We lived through Jimmy Carter. I mean, the Republic will survive. Ireland has lived through more woes than anybody. And Ireland is still Ireland. It's still green and wet during the winter. So the answer is in the economic world, we're in trouble.
Right.
Okay. But I should say in the financial world, we're in trouble. Because as you say, inflation is at 6% now. I wouldn't be surprised to see if it's a 7% handle in December, January. The way inflation is figured in the United States is they use something called owner's equivalent rent rather than actual housing prices.
Right. Okay. Explain that to me.
And the rents and the way they figure it is through a survey, and it's kind of hokey. Rents year over year are up 18%, but in their gauge, they only have it at 4%, 3.8%. So I mean, it's way understated. If they were stating owner's equivalent rent correctly, the number would be like 8 or 9%, and the Fed would be being forced to step on the brakes. And eventually, that number will make its way into the number as other prices come down. So I guess they're hoping somehow that that it can just kind of balance itself out.
Your upward pressures are kind of countenanced by a few kind of downward pressures as well.
Right. But what's going to happen though is in March. Remember last March when COVID hit in the United States, it sent us into a deflationary crunch, and it was obviously a spiral. The Fed reacted, but the year-over-year comparisons starting in March are much easier from the Fed's standpoint, because you're not comparing. The inflation's kicked up pretty quick, so the year-over-year comparisons, which is what everybody cares about because it's the headline number, is going to be more like, even if inflation was exactly the same, it would be like 4% rather than 6 or 7.
Mm-hmm.
So it's just the year over year, everything changed last March. And then so going forward, you have good comparisons if you're trying to hold inflation down. The Fed will be able to say, look, something's happening. And the answer will be no, not anything's really happening, because the inflation is not caused by low interest rates, except for housing, or quantitative easing. The inflation that we've got today was caused by Congress throwing $6 trillion into the economy. And that $6 trillion is hot money. Mm-hmm. I mean, it got into the hands of people and they spent it. And what happened was they couldn't spend it on travel. They couldn't spend it on leisure. You couldn't go to restaurants. You know, it was a very reduced set of goods and services that you could buy. So people bought goods. And if you look at, for instance, you think, well, they're not shipping, the stuff is not getting through the ports in you know, Los Angeles and places like that. We're actually pulling a slight bit more containers through the ports than we did in 2019.
Okay.
Okay, it's just that there's just so much demand.
Yeah.
So it's stacking up. We didn't build in the United States or in China or anywhere in the world. We didn't build the infrastructure to handle that 10 to 15% boost in demand.
So you still got the same level of capacity, and your pipe is still big, still the same size, and you're just trying to throw more stuff through it.
You know, we're through it, and now what will happen as, you know, the COVID becomes endemic, and you know, hopefully Omicron becomes more like a cold, if you will. I mean, it has a lot of different variants, but something like, I read the other day, 14 of its spikes are found in what's not in the most common cold, which is a COVID variant. I mean, and that's the way viruses mutate. They want to live. And if they kill you, then they don't get to live. So they would prefer to make you mildly sick, or, you know, in fact, they'd love just to give you the virus and not make you sick and have you just spread it everywhere. That's a good day for the virus. That's its only evolutionary demand, is to spread. But it'll all even out. I mean, we'll get this done. We'll get vaccines and other things that will take care of it, medicines that will affect it. And so the demand will come back into services and so forth, but at higher prices, because we've seen that go up. And the demand for goods and services that's not fueled by massive stimulus is going to drop. There was stimulus in, you know, countries all over Europe and Japan. I mean, everybody did they all read the same playbook. So it evens out, but it's going to take a while for it to even out. I mean, I read yesterday the chairman of Cummins Diesel, which makes big trucks and diesel engines here in the United States. He says, we expect to have supply problems in computer chips. And we're not talking really advanced computer chips here. We're talking run-of-the-mill computer chips. We expect to have these supply problems for another 2 years.
Wow. Okay.
We just can't crank out enough trucks for the demand. And, you know, the same thing with automobiles. There's, I'm told, I've not seen pictures of it, but there are hundreds of acres of cars sitting in a lot waiting for a chip. You know, that just, you know, it's when they get that chip, they put the chip in and the car goes off. The same thing with so much. I mean, here in Puerto Rico, I have a swimming pool. My neighbor has a swimming pool. And we were talking about, randomly, both of our pumps have gone out at the same time. You can't buy a pool pump on this island to save your neck. They're all in backlog, and it's going to be, I mean, they've got a temporary little gadget fixed on it that barely gets the water through. But you know, everything's backlogged. You know, it's annoying, but there's nothing you can do about it.
But you still expect, though, that, you know, kind of come March, the year-on-year comparisons are going to settle at a higher level anyway. We're going to have an excess of upward pressures, and we'll see a higher inflation rate.
I think we could see 4% inflation,
okay,
for a while.
And back to then that quote of yours.
Unless we go into a recession.
Yeah.
Yeah.
Yeah, you're suggesting then that even a moderate 3 to 4% inflation trend could have catastrophic long-term effects.
I mean, 4% inflation rate, you lose half the value of your purchasing power in 18 years. I mean, that's you know, now if you're a debtor, that means you now owe, you know, if you keep up with your wages and other stuff, you now owe less technically in terms of real value than you did before. And in theory, it should be good for gold. You know, we'll see what stores of value really look like. But I don't expect that inflation is going to get its claws in us and be like the 70s.
Right.
I think it's a supply side, you know, created too much demand, not enough supply. And let's face it, you're a business, a manufacturer, and you see this demand come in, and you can build another plant or another production line, but you know that 12 months from now, you're not going to be able to use that. 15 months from now, you're not going to be able to use that.
Because the demand is only temporary.
Because the demand was a one-time, one-shot boost from the federal government. So you just say, let's do what we can with what we've got. And you're having trouble hiring employees anyway. And we'll just work through it. And you're getting a lot of inventory build. There are companies that the line is, I'm just merely building inventory for, it's no longer just in time manufacturing, it's just in case manufacturing. And so I'm building inventory. Those other guys, they're hoarding, but I'm just building inventory for a normal person. Is
there a risk then, John, that, you know, the inflation that we have seen and these numbers that we're seeing now, 6%, and the 7% that we're expecting potentially in December, is there a risk then that at certain stage that this starts to become upward wage inflation?
Oh, it already has. It's already doing it.
And does that upward wage inflation then have a kind of a knock-on effect, a kind of a spiraling effect?
So wage inflation is sticky. Okay, I mean, it's my son and his girlfriend are moving to the Orlando area, and he called me up and said, because he had a particular type of job that he wanted, and he, you know, knock on wood, he found it. It was a good paying job. But he was looking through, when he just got out of high school, he had done food prep work. He's 25 now. And, you know, he'd work in the back of a restaurant, you know, or a bar or whatever, just doing food prep. They were paying $18 an hour at Cheesecake Factory for food prep, something that was getting maybe $9, $10 an hour 2 years ago. I mean, the maid in New York, I was staying at a hotel in New York, she's getting $30 an hour.
Wow.
It's just.
And on a temporary basis, businesses can weather that. They can suck that up, but after it doesn't take too long before prices have to go up.
Well, prices did go up. My hotel room was not cheap in New York. I was talking with a guy last night. I had actually been on the board of a hotel group. We owned 125 hotels at the time I was there. I turned 70 years old, and they kicked me off. thankfully they kicked me off right before COVID, so I didn't have to go through that.
I'd rather be lucky than good.
I'm friends with all the guys on the board, but it was an extraordinarily painful time because they were having to let hotels go.
Yeah.
I mean, this was a big multi-billion-dollar hotel chain, that owned hotels all over the U.S. And we were talking about hotels in New York because there's one up for sale, and then we were looking at it, and it's relatively cheap compared to what it has been. But there are no, he was talking about all of the cheap hotel rooms in New York, they're gone. There's no more cheap hotels. All the prices are going up. Car prices have gone up. Used car prices are ridiculous. It's just kind of one thing after another. The inflation it'll eventually sort out, and we'll move back into a disinflationary, deflationary world because of demographics, because of technology innovations. Technology is inherently deflationary. Okay, but in the service world, you can't really increase output that much. I mean, a bartender's still a bartender, a maid's still a maid, a retail clerk is still a retail clerk. You can't make them that much more productive.
Yeah, we haven't automated.
You're not going to get scale.
Yeah,
but you're still going to have to pay them. You still have to have them.
Yeah.
And the prices are going up, so you're going to have to. Businesses are going to have to raise prices. And in essence, that's what they did last year. Corporate profits in the U.S. were up last year, percentage-wise, year over year, and year over 2 years. And they were up because businesses raised prices. And it's showing up, in the CPI, in the way the Fed uses it, it's change prices, but personal consumption expenditures is the way they use it. It's just another, it typically understates inflation a little bit more, but that makes the Fed's job easier. But what they're going to have to do is, and I like the fact that Powell's doing it now. He's reducing quantitative easing first, and it's what he says he's going to do, and then they'll start to raise rates. And they're talking about, we'll find out next week, they're talking about doing it faster. I would like them to do it faster. Now, that's not going to make any difference on inflation, other than it'll take a little pressure off of housing when they start raising rates back up. Quantitative easing did not cause inflation. It caused, except in asset prices, it caused stocks, all sorts of financial assets, and home prices to rise. They pull the quantitative easing off. It goes into a neutral form, so you're not really pushing it in. That could cause a little bit of a disappointment in the market, and then they start raising rates, and they could be at 1.25%, 1.5% by the end of next year, which doesn't sound a lot. I mean, if an economy is not strong enough to handle 1.5% interest rates, you're in trouble.
Yeah. Well, we've had, zero or close to zero interest rates for a while now, and I mean that has fueled a massive rise in stocks. So even 1.25%, is this going to upset the stock market a lot?
I've given up predicting the stock market. I mean, honestly, I think price valuations are absurd on any historical level. It takes buying and a lot of it to create a stock market, a bull market. All it takes is the absence of buying on the margin. That creates a bear market. I mean, you don't have to have people selling. You just have to people saying, I think I'm full.
I bought enough.
I'm going to stop buying. I mean, I was with a friend of mine here, and he's wealthy. and he's selling his entire bond portfolio.
Right.
He's 65 years old. He's getting rid of all of his bond portfolio, going to private credit. He's there's a trade that a lot of guys around here do. By the way, Puerto Rico and the area that I live in, Dorado, is the epicenter for Bitcoin and cryptocurrencies and blockchain. I mean, there's just hundreds of these guys have moved in and they bid the prices up on nicely high-end homes here, just randomly. But there's a lot of traders that I meet that will go out along the trail, the timeline, and they'll buy puts and calls, the same strike that makes them neutral in Bitcoin or another crypto. And then they use the futures, and the futures deteriorate over time. And they can make somewhere between 10 and 12% a year risk-free. Now that's better than bonds.
Yes.
I mean, you've got to, this is one of those things that you don't want to do this at home, boys and girls. You need to be a professional. And eventually there's going to be so many people doing it that spread will go down. That deterioration will go down because they'll just bid it up.
Yeah.
So if somebody's listening to this a year from now, you might want to go out and it's
not going to be 12%.
And you go and look at the market, you say, that John doesn't know what he's talking about. But you know, I don't know how long it'll take. I do know that I was in the commodities markets business. We ran commodity funds in the 90s, large ones, and somewhat into the 2000s. And what went from being in the early 90s, making money hand over fist with, you know, we had multi-trader funds, which, I mean, life was good. You make 25 or 30% a year. Those spreads, as more and more people got into the market, so spreads came in, and now commodity funds, except in very niche areas, are boring. The spreads have gone away. There's too many big players at it. And the same thing will happen with the Bitcoin spreads on their futures. It always, if something's too good to be true, there's going to be too much money going into it, and it will end up being not true anymore.
If we find ourselves in a world next year where we've got interest rates at 1.25%, first question is where does that put yields on the long bond? Obviously significantly or potentially significantly higher than where they are now.
Not necessarily.
No,
not necessarily. Let's right now, if you had interest rates at 2% and the economy was slowing, you could see an inverted yield curve.
Okay.
I'm talking about a year from now. Okay. I mean, if you look at 20s and 30s now have already inverted. The entire, if you look at the yield curve, except where it's being physically captured down at 0, the rest of the curve is trying to invert. It's moving out. So that, and what a yield curve doesn't cause a recession, but it tells you there's something wrong in the economy. There's something wrong in the system. And it doesn't always say the same thing is wrong. It just says something's wrong. You know, you've got a virus, you've got fever, you're gonna need to do something about this. And there's not much you can do. And so the Fed's gonna have a huge problem is over time, you know, as they raise rates, it's gonna have an effect on the economy. And you get a small bear market that can become a larger bear market. And then Jerome Powell has to choose. Am I gonna fight inflation? Or am I going to back the stock market up?
For the last number of years, it's been the stock market, and now only
the stock market.
Recently,
it's the wrong choice. I think the Fed made the policy mistake a year ago by not starting to take the quantitative easing off, by not starting to be ready to raise rates this last summer. They should have started backing off quantitative easing a year ago, which I was writing. I mean, it was the economy was coming back. It was doing good. We didn't need that much quantitative easing. The market was certainly, okay. So it's.
Does Jerome Powell or the Federal Reserve, do they have the fortitude to continue to raise rates in the face of either a taper tantrum or a crash in the stock market?
Hope they do. I'm more worried about inflation than I am a temporary bear market.
Okay.
Okay, let's handle inflation, and then the markets will come back. Now, if you're a trader, that gives you opportunity to play both sides. If you're a long-term investor, you're fine. You may want to put some puts, some calls just to take advantage of it. But if you're one of these guys that the market goes down 20%, you sell, and then you try to buy back in, and then you're not going to do very well. I will tell you, in my personal portfolio, I have a number of hedge funds and traders in my portfolio, and they trade, and I don't think about it. They do my trading for me. They think about it. I have 4 stocks in my personal portfolio. They're all biotech stocks, and I don't look at the price. I don't care what the price is. I'm buying them for 10 years.
Right.
Those are different animals. But most of everything else I do is I give it to other managers, and I let them manage the business, and I choose my managers very carefully. Now, I should say, I do have one position, since this is a gold show. I do have one position, and it is gold. And
what's your motivation for holding gold in your portfolio?
I came up, in my 80s, a fan of the Austrian economics. I'm no longer, I'm more of a classical economist than I'm an Austrian, but I bought my gold in the early 2000s at a cheap price. I became bullish on gold at 2002 or 3, something like that. And it's sitting in a vault in Dallas. And the value has gone up. So but to me, gold is central bank insurance. Okay. Because just as we're talking, the Fed and the US Congress can make mistakes. That last 2 trillion, that last 1.9 trillion that they did in March of this year, they shouldn't have done that. Things were already going on, maybe a little bit more, but they extended it. And that's what that was the inflationary juice. And Congress seems to think, well, no, we don't cause inflation. That's the Fed's responsibility. No, it's the fiscal policy for the last 2 years of this Congress, bipartisan, by the way, has been massively inflationary. That's what deficits do.
Do you think they're joining the dots in terms of the inflation problem, where it is actually being caused, or do you think that there's a chance that they might go back to
the inflation problem? See, the Fed needs to raise rates and get us out of the severe negative yields that we're in, and let the markets balance, let the markets handle themselves, and stop trying to juice the housing markets. Stop trying to, I don't know that they'll ever be able to get short-term rates much above 2 to 2.5 on a sustained basis, not given all the debt that's out there right now. That debt is really, it's future consumption brought forward. It's massively deflationary. So I think the latter half of this decade is going to be very, very tumultuous.
Now, one of the
you can just see the forces kind of building. You know, you've got your fourth turning social principles. Neil Howe writes about. You've got geopolitical cycles that George Friedman writes about. All of this stuff comes together in the late 20s. It's just so.
And just touch on that geopolitical issue. One of the reasons that the US has been able to increase its national debt to over $29 trillion over the last number of years is there has been an appetite for US bonds historically. We're now in a situation where there's a program of de-dollarization by the likes of Russia and the likes of China. Can the US and can the US dollar continue to maintain its reserve currency status going forward in the same way that it has historically, or at least for the last number of decades?
What's your choice?
In terms of
your reserve currency?
I don't know. So it's a case of it's
that's what I'm saying. There, the dollar is default. I mean, are you really going to make the renminbi in a country that's closing itself? That's that's running the. Xi has clamped down on technology. He's spying on everybody. You really trust those people with your money? The euro running negative rates. Euros would be okay, but it's not really a reserve currency either in a major way. The dollar is right now. I mean, it was the pound for up until it was the dollar, and it stayed the dollar. Now, will the dollar always be the reserve currency? No, but I don't think it's going to change in the next 10, 15, 20 years. I mean, I just don't see another country coming along, another currency coming along. I mean, look at the countries with really solid currencies. Norway, Switzerland, Singapore. They're too small. I mean, you can't do global trade with the Swiss franc or the Norwegian kroner. It just doesn't. It doesn't work. Now, would China like to use more RMB? Yes. Will they do it in their influence zone? Yes. I don't care what Russia does. They're too small. I mean, they're barely bigger economically than Netherlands. So it's I mean, you wouldn't be thinking, you know, going back to the I was going back to the Dutch currency. I mean, at one time was a reserve currency. These things, they'll change, but I don't see the dollar for a few decades at least. Let's get into the late 30s and 40s. Let's see how the world has rationalized all that debt that we can't pay. US is going to have a big day of reckoning. Europe's the same way. We're all going to have to do stuff that the markets aren't going to like, that none of us are going to like. It's going to cost us more in taxes. We're going to get less benefits than we thought we were due because we just can't pay it. Or you're going to create inflation and inflate it away. Well, that's a terrible outcome. I'm not being doom and gloom. I mean, in the midst of all this, there's going to be hundreds of new innovations. Scores of companies are going to become worth billions of dollars. They're going to transform our lives. I mean, I'm not wanting to go back to the good old days. I'm wanting to get through the 20s, and I think the 30s are going to be an awesome time to live.
One question then before we wrap up. Obviously, we've seen an awful lot of stimulus over the last couple of years, and it has been a massive contributing factor to inflationary pressures. If we see a change in terms of a mutation of the virus and we head back into some sort of a lockdown, or like we've had in the past, or Congress in the US decides another stimulus package is warranted for whatever reason, is the case then that all bets are off? Inflation is heading even higher. Stock market's heading even higher.
I think, given where two Democratic senators have pretty much laid a line in the sand, that you're not going to get a massive stimulus bill. I'm not certain. I mean, they keep talking about trying to get this Build Back Better program. They now say they've got it down to $2 trillion. They've done it with by shortening a program to 1 year or 3 years rather than 10 years. So we're not spending $1 trillion on this program. We're only spending 200,000 on it. I mean, 200 million or whatever. But once you give people this program, then they're going to expect you to extend it. I don't know that Manchin and Sinema are going to let that through. Something will pass, but nowhere near what the progressives are wanting. And then next year, the odds are very high that Republicans will take a pretty big sweep in the House and will have a shot at the Senate. And so then there won't be any more stimulus bills.
John, before we wrap up, maybe just like to tell us how people can find out more about what it is that you do.
Well, the easiest thing to do is go to Mauldin Economics. Just Google my name, John Mauldin, and you get to Mauldin Economics, and I write a newsletter that goes to 1 million of my closest friends. Is free. It goes out every Saturday morning, and you just stick your name in there and your email, and off we go. So that's the easy thing to do.
Are you also active on Twitter?
I am at John F. Mauldin on Twitter. Yes.
Super. Well, what I'll do is I'm going to put a link to both of those, your website and your Twitter handle, in the show notes and description below this video. So anybody that wants to reach out to John or connect with John, sign up for his newsletter, follow him on Twitter, can do so. But for now, John Mauldin, thank you for joining us on GoldCore TV today.
It was good to spend time with you.
Thanks for watching. If you enjoyed this video, make sure to like it, share it, and comment down below. And if you want to see more interviews with industry experts and thought leaders in financial markets, subscribe to GoldCore TV and hit the notification bell now. And if you want to watch more interviews, I can highly recommend two of my recent interviews, one with Dr. Stephen Lieb, rapidly becoming one of my favorite interviews of all time, and the other one, extremely insightful, with Danielle DiMartino Booth, ex-Federal Reserve advisor. And if you want to learn more about how to buy, sell, and store physical gold and silver, log on to goldcore.com, your precious metals experts.